For those of you who don't know me, I'm Rick Rule, I'm your host. This is a special panel, I want you to know. For many, many, many years, you all have told us on the attendee surveys that your favorite part of the program is the living legends. In the living legends, we have a panel of people who have built multi-billion-dollar companies from scratch, telling you, not just beating their chest, which they do, but telling you too how they did it, what they learned, the mistakes they made, and how those mistakes made them better investors, and how you can be better investors too. The purpose of the entire symposium is to help you be better investors. It was suggested to us a couple of years ago that we should expand the living legends concept while including the living legends that had built multi-billion-dollar companies. Attendees suggested to us that we start an investor legend panel. People who had invested in the sector through good markets and bad, through thick and thin, through bull and bear markets, made money successfully, learned lessons, made mistakes, and had lessons to impart. What you wanted is basically my job description, so we've created that for you this year. It's my pleasure to introduce to you in no particular order, gentlemen, come on up, Ralph Aldis, U.S. Global, I guess you call yourselves now, no longer United Services. Long-term friend and colleague, Adrian Day. Frank Giustra, a competitor and customer and every other thing of mine for many years. And last but not least, Jonathan Goodman, who you just heard, and by the way, whose father was one of my earliest and most important mentors. This panel was chosen because of a demonstrated success over years in mining exploration and mining finance. People who made money through good markets and bad markets, people who had stood the test of time. My suggestion to you is now that we're in a gold market, there's going to be a whole bunch of newly minted experts. People who in the next 3 or 4 years will talk to you about mining investments, but people who unfortunately 4 years ago couldn't spell copper or uranium or even gold. The gentlemen in front of you, through thick and thin, through good times and bad, have been investing millions and sometimes billions of dollars in the sector that you're going to invest in now. We're going to ask them to describe what they did well. We're going to ask them to describe what they did poorly. We're going to ask them what they learned, and we're going to ask them what lessons they want to impart to you. The investing legends and the living legends are important because of something called Pareto's Law, performance dispersal curves. You may know it as the 80-20 principle, because that 20% of the population generates 80% of the utility in any given function. What you need to know is two more things. It's a bell-shaped curve. The good guys, this 20%, do 80% of the good work. There's a different 20%, the bad guys, who do 80% of the bad work. So your first job is to find the good 20, locate the bad 22, but stay away from them. A more important realization is that each lip, the good lip and the bad lip, when run through the same performance dispersal curve, conformably align, which means that 20% of the 20 do 80% of the 80, where 4% of the population generates 65% of the utility, and the other, elected officials, cause 80% of the harm. These gentlemen here, the third standard deviation, the 1% of the population that generates 45% of the utility, so it's a special crew. I'm going to begin by asking each gentleman to describe very briefly how they came to be here, what it is that they've done, and talk to me and the audience about what you consider to be your durable competitive advantage. How did you succeed? What is it that you did well? I should actually, before I do this, I should tell a little personal story to put it in context. In 2011, my business, I say my business, not me, my business got bought by Eric Sprott. Because of American legislation, he couldn't buy me as a slave, but he bought me. And when we were getting to know each other, we were comparing techniques for investing. And he was asking me how I did what I did, how I generated my success, what was important to me. I explained to him that I was basically a pawnbroker, that I looked at the value of things relative to the price, And I figured in a business like mining where your upside took care of itself, what you had to do is protect yourself as best you could from the downside. And Eric started laughing. Interesting response. And he said, that's funny, Rick, that what you say is the upside takes care of itself. I'm exactly the opposite. I look for my upside. I figure if I have a 20-bagger or a 30-bagger, that amortizes a whole bunch of stupidity elsewhere in my portfolio. Now, to be honest with you, Eric is wealthier than I. So it might be that balls to the wall makes more money than measured risk assessment. But with that, I'd like each of the gentlemen, and John, I'm going to start with you, to describe what they would to tell us a little bit about your background, but tell us how and why you've been a success, how you stayed alive in mining for 40 years.
How I've stayed alive in mining for 40 years? Well, first of all, I blame my father. Because when I was 15 years old, I worked for a brokerage firm in Toronto called Merit Investment. And I worked with a guy you probably know, Bob Rose. And so I took all my money at the time and bought a stock that Bob had recommended. And it was Consolidated Morrison. And I went out that night, I went out for dinner with my dad and one of his close friends and told him I just bought Consolidated Morrison. So over the course of that night, they berated me about what a stupid decision I made. And of course, the next day I went in, I sold all the shares I bought. The stock was up. I think I made $100 after commissions. I was very happy, but I then watched the stock triple over the next 3 weeks. And so finally I went and confronted my father and said, you screwed me. And he said, no, I didn't. He said, you bought the stock. If you had done your homework, you wouldn't have cared what we said. If you didn't do your homework, you sold it. So clearly you did no work. It's your fault. And you got to own it. So that's why we do all this due diligence. We trust no one. We do our own work. And that's what we've survived with.
So what my audience should write down is keep your own company. Is that right?
Sorry?
Keep your own company. Have enough courage of your convictions, do enough work that you don't give a damn about the misinformation in the market around you.
And eat your own cooking.
By the way, a special acknowledgement. His father, despite that one piece of maladvice, was one of the most important mentors of my career. And literally, I miss him always. Yeah. Frank, your history?
I thank my father. My father introduced me to the stock market when I was 19. I didn't have any idea what the stock market was. He was a miner who actually worked in mines and he used to play the penny stocks. And he was just an absolute gambler. Never made any money, always working on tips and blew his brains out every time. And that taught me not to be a gambler. And so my approach to investing in other people's ideas has always been about calculated assessment of the risk and the reward, and not to ever gamble. And I'm a coward when I invest. And I really, I take shots, but they're very calculated. There is risk, but again, it's calculated, and I always know what my downside is, and what I'm willing to lose.
Frank, you told me 2 decades ago when we were visiting that your mantra at that point in time was get in extremely early with good people who A, you could trust, and B, you could help. Mm-hmm. Help them build their fortunes and hang on like a rodeo rider. Just hang on.
I paraphrase that. So buy early, buy large, be patient. Back management that has a track record. For me, I've worked over and over again backing people that I know well. I know what they're good at. I know their blemishes. It's the devils I know. And Ian Telfers, the Neil Wood years, the Fino Iaconos. And I know they're good and bad in each of them, okay? But you know what you're getting, and you know that they succeed in the end most of the time, and you can ride that. You can basically place your money on that jockey, and it's a formula that's worked for me. So I've worked over and over again with similar people, and occasionally, as I've done the last couple of years, I take new people under my wing. And they're younger, they're hungrier, they're smart, and they're hardworking. So We figure out a strategy. I provide my sponsorship, my financing, and then they do all the hard work and I get the credit. It's great.
Adrian, you and I have known each other for now 4 decades. We've invested together for 4 decades.
Mostly successfully. Well, first of all, Rick, I'm actually really humbled to be on this panel with these people, and thank you very much for having me. Gosh, already there's so much to talk about that these two gentlemen have mentioned. But I'll just mention, both Jonathan and Frank mentioned their fathers, and I'll mention my father as well, because even though he never invested in the stock in his life, I mean, I'm from a very poor background. We didn't, investing was just not something we talked about. But what I learned from my father was, certain traits of discipline, of patience, not wasting money. And those things have really stuck with me all the way through. And I think one thing I learned a lot from my mother, but one thing I learned from my mother was the absolute importance of hanging around good people. Now, she was talking about my friends and who I went to the cinema with on a Friday night, but just being with good people is absolutely imperative. So, frankly, I think those things, those virtues, if you like, that I learned from my parents is what's enabled me to, survive. When you said, tell us why you're up here today, it's because we've survived. But, and that in itself is quite a feat. But, I think it's those virtues that I learned from my parents that help.
Adrian, would I be fair to observe, and feel free to tell me I'm crazy, would I be fair to observe that the fact that you grew up in England and as a consequence became an international investor at an early age, you've been less ethnocentric. You've been willing to invest in Australia. You've been willing to invest in Africa.
Oh, no, absolutely.
Would you suggest that that's been part of the architecture of your success?
Oh, no, absolutely. And we could talk about that for a long time, but don't worry, I won't. But, first of all, because England, or Britain, I should say, is a very small country. And secondly, because we used to have an empire, so, we've been to lots of different countries, have roots in lots of different countries. The idea, if you talk to an English investor, the idea that that person would only buy English companies, it's just so perverse. It's like saying, well, I like hamburger. The only food I'm ever going to eat in my life is hamburger. It's just not something anyone thinks of. And when I first moved, and you see the same in Switzerland as well, and countries like that, where people just naturally think of investing globally. They don't think of investing purely domestically. And one of the things that really struck me when I first came to this country in 1974 was just how, don't shoot me, just how ethnocentric people were here in everything, whether it's in sports. I mean, the hubris of calling the baseball the world champion when basically it's Japan, Cuba, and America, and so on. But people's investing was really very much focused on US, and they used to talk about global stocks as foreign, right? It was US or foreign. I don't look at it that way at all. I look at it as global.
Ralph, you represent what we all in the old days would have known as United Services.
Yes.
Now US Global, you all have been, well, let's just say the gold is in your DNA going back.
Yeah.
You've been doing this, as is evidenced both by the hair and the
Yes.
beard, for a very long time. Tell us something about your methodology. Tell us how you came to be successful, and tell us what lessons in terms of success you could impart to this audience.
Okay. I mean, I can't throw my dad under the bus and not mention him, but he did suggest that I go into geology, where that was coming out of the 70s and the mid-70s and the oil crisis and so on. But that's what I ended up doing, and I got undergrad geology, master's in mineral economics, and started at US Global. And actually, I've been there almost continuously. I left for a little while to go work for my previous guy that I worked for in college for a little bit. But I've been doing this gold thing all this time, and mainly precious metals. I think what's given me the ability to hang in there is doing more of my own valuation. And it really came down to all these NAV models that you see out there, they throw at you. You can make the answers whatever you want. I mean, it's just, it's almost, for some people, they can do that. not everybody. But it's kind of like, it's hard, it's very difficult there to kind of drew your valuations from that and relying on third parties. The other thing I did is I took, at Colorado School of Mines, I took the real options course like 5 times. It's wondering, like, what are you thinking? But what I sort of came up to is like, today, when I value a company, I want to see the resource statement, because that's the only independent information that you have, really, about the company's asset. And so that's important, and I find it so distressing that companies even lack, sometimes even putting the resource statement in their slide deck. I mean, are they not doing any research and development? I don't know. But from that resource statement, what I can do is, from valuation, I can do sort of a real options approach, but I can look at the number of ounces, the grade, the gold price, what is the metallurgical recoveries, what is the expected dispersion, and from that resource statement, I can develop a pro forma market cap for where that company should trade on based on a fully built operation. If it's not fully built, and it's just a little small company, it's got 30 million market cap, and it's maybe only got a $200 million asset, so they've got 170 million that they can invest before they're spending 20s to pick up 10s. They need, that asset needs to be big enough to cover that capital plug. So many times, as you see in the gold industry, people are spending 20s to pick up 10s because they don't understand the simplicity of it. But the resource statement drives the valuation, and if you can value that, you can value any company out there, you can value an exploration company and how much capital they need to get there.
Now we're going to turn it around. I ask you the easy question first, Put yourself in a glowing light, how did you become legends and all this kind of crap. Now we're going to turn it around a little bit. I want each of you to give me either your defining mistake, which is to say the stupidest thing you've ever done, or, alternatively, the mistake that you keep making.
That's really dumb.
That'd be the stupidest.
Now, I have 2 of them. There was something called Heating Oil Partners years ago that was cheap, but it had a distressed balance sheet. And I thought, well, I could actually fix that balance sheet. So the risk is gone. And I assumed that the management team would be logical. The management team was illogical, or perhaps they were self-serving. They put it into bankruptcy, bought it out of bankruptcy themselves, and my investment went to 0. That was stupid. Assuming that somebody else was going to be logical or not self-serving. My other mistake is that I'm always early, personally. In the first uranium trade, I was 6 years early. 6 years early at an 8% cost of capital is arithmetically not early, it's wrong. So my own repeated mistake is if I assume this is true, this is true, this is true, this is true, and this is true, I confuse the word inevitable with the word imminent. So, mea culpa, I've done mine. Jonathan, either your defining mistake or your repeated mistake, and what investors can learn from your mistakes.
My repeated mistake is, as a large investor in a lot of companies, we sometimes find ourselves at odds with the CEO of the company. And I'm the one saying, no, we got to give this person a lot more rope. Because if I have a weakness, I have a weakness for entrepreneurs, and I recognize that. And 9 times out of 10, I give them too much rope. And I have others in my management group keep telling me, you're just being too nice to these people, and it almost always works. That we should be stepping in there, talking to the board, and saying, guys, you need to change management, and that's some. I guess maybe I have too much faith in some people, but I give them probably too much latitude, and I'm trying to get a little tougher in my older age.
So let me ask you a question. From your viewpoint, and from the audience's viewpoint, are you better off to thank and excuse, to allow that CEO to pursue other productive employment, or are you better off to sell the stock, walk away, and let the other shareholders work?
Well, that's my other problem. I kind of fall in love with ore bodies. So when I see a great ore body, and I see it's fumbling because the great ore body, you know, the real truth is bad management can screw up a great ore body. And that is a truth. So I tend to want to stick it out with the ore bodies because there's not a lot of good people, but there's more good people than there are great ore bodies.
Frank, you heard the question.
Jonathan, thank you for pointing out your weakness. I have some people I'm going to send your way.
Just tell them that Frank sent them and I'll know what to do.
Yeah, exactly. I can't think, I'm sure there are examples, I can't think of repeated mistakes, but I certainly can remember one of my greatest mistakes, which will not be repeated. And I do a lot of mentoring with young people through an organization I help create. And what I tell them is that in business, and when you're successful at doing something and have had past success, and you're doing something new, leave your ego at the door. And I made a very big mistake when I created Lionsgate Entertainment back about 30 years ago. I'd just come off of being the chairman and CEO of an investment bank that had done really well in the mining game. It was called Yorkton Securities, which I left in 1996, and I decided to create Lionsgate the following year, and I thought it was a genius. I thought that since I built an investment bank, I could build a Hollywood studio and do it in short order. So with tremendous ego, having come off a huge win, I bit off a lot more than I could chew. And it almost sunk us. The first 3 years of Lionsgate, from 1997 to 2000, were the 3 hardest years of my life. We almost went bankrupt twice. I had to make payroll personally. We had tons of employees. We got the cash flow projections all wrong. I tried to build the components of that studio too quickly because I wanted to have a big splash to show people how intelligent I was, and that it wasn't just the brokerage business I was good at. I was going to be a studio Hollywood mogul. And you know, it was a valuable lesson. And I'm actually in the process of writing a book, and there's a whole chapter in that. And the bottom line is, you know, in business, leave your ego at the door, always. And and if you're especially if you're successful, because then you tend to think that you're super intelligent and you can do no wrong.
Ladies and gentlemen, I might point out that failure is responsible for the Hunger Games series and a hugely successful New York Stock Exchange company today. Had only all of my failures performed that poorly. Adrian, I know some of your failures, like I know your successes, but I'd like you to discuss either your defining failure or your most repeated failure.
Okay, well, you keep quiet, Rick. I can certainly say one of my repeated failures that I don't think I do anymore. So finally, after 7 decades, I've learned something. And it sounds so obvious when I say it, people must think I'm an idiot, but is buying things when you don't really know enough about them. It could be, I mean, at the base, it could just be a tip from a friend. I haven't done that for a long, long time. But it could be only seeing something, talking to people, only seeing the upside, and not doing enough work and not really knowing and understanding. And the understanding is even more important than knowing all the facts and figures, but just understanding the business and understanding what could go wrong. And all of my mistakes, not all, sorry, I think most of my biggest mistakes, I'm defining mistake as investments on which I've lost money for myself and my clients, all of my biggest losses have been because I really didn't know and understand the company. And that's critical for a lot of reasons, obvious reasons, but it's particularly critical when things go wrong at the company, as they inevitably will at some point. So either something goes wrong at the company, or let's say the stock price sort of collapses and doesn't do what you expect. If you really know the company, you know whether you're supposed to double up on that or run away. And if you don't really know the company, you're sort of floundering around not really knowing how to react. So that's my biggest mistake.
Ralph, same question.
I think it's been a repeated mistake, and I'm trying to learn from it. But it's like you might say when to sell, but it is part of it. But it's like the issue, though, is you get these waves of investment stuff, like we've been going through this nickel wave, this copper wave, and now maybe this copper wave is going to be real with these tariffs. But you get these companies, when they market the big picture to you, and you really need to think about maybe the details that they're selling you as opposed to the big picture. You get caught up in the investment themes, and you know, the difficulty is knowing when that theme is running out, or when, you know, what are the weaker players in there. It's, you know, and that's like part like knowing when to sell. I had stuff that would get up, you know, Convex got up to be 17, 18% of the portfolio. I should have took more off the table. But, you know, there's other things like, you know, you have those successes. Kirkland Lake, I was in at $1, and it went up like to 30, but I was sold going into that. But it was just, you know, that actually was the counter. I shouldn't have sold that one. So it's not always that easy to know when to sell and to not get caught up in the hysteria around some sort of cycle. That's where I think you get astray and you just think everything can go up.
Now we're going to switch things up. You know, we're up here as educators and, you know, sage old pros and all this stuff. We think that our job is to teach folks how to fish. But that's not what the folks want. The folks want us to catch the fish, clean the fish, prepare the fish, and serve it up with appropriate garnish. So what I'm going to ask you to do now briefly, because we only have 9 minutes left, is talk your book. What do you own? Not what should people do, but what you do. And by the way, that'll make this the most popular panel of the whole conference. Education aside, give me a name to write down, damn it. John, what do y'all own?
You know, I can tell you to buy Saturn Metals and Magna Mining, or you could buy them at a 43% discount by buying Dundee Corporation.
See, I told you, education be damned. Give me a name.
Yeah, I give you
Frank,
three.
Frank, you know, you've had these horrible failures like Lionsgate. What are your current failures? You know, what do you own now?
Yeah, again, I'm an investor and a strategic advisor to a lot of companies. And I have two formulas that seem to work. One is the buy and build strategy, which we deployed. Wheaton River Gold Corp was our greatest success, and that was a buy and build strategy. So it was both doing M&A work to grow a company and also build gold mines. Then we did Endeavor Mining in 2009, same idea. Leia Gold in 2016, which merged with Equinox, same idea. And my current one is Eris, which is, again, a company that's aspiring to be a 1 million ounce a year producer over the next number of years. And it's, again, using the same exact strategy. So it ain't broken, I don't fix it. It's a strategy that's worked well for me. Others, like Friedland and Lundin's and the Ross Beatties, place their bets at the bottom of a drill hole. I don't do that very well. I'm not very good at that. It's too risky for my sensibilities. The other strategy, which we've used in the last couple of years, and again, it's worked really well for us, is buy the distressed asset and fix it. If it's a great asset that's been poorly managed or is part of a business combination that's going through structural problems, you know, debt problems, we've acquired West Red Lake, which is the old Madsen mine, which I think gone bankrupt twice before us. And, you know, we took it over for very little money and then had to put another $200 million into it to put it back in production, and now it's working nicely, it's ramping up. Same idea with Next Metals, which is the Saleeby and Selkirk copper, nickel, platinum mine in Africa. Again, great asset management, just went rails doing a whole bunch of very silly things, including debt and whatever. And we took it over, again, took control of it for very low money, and again, put in proper management, and then really realized the value. Next Gold, which is the two big deposits, one in Nova Scotia, one in Ontario, 6 million ounces in total. There were two different companies, both distressed, both with debt, both that needed restructuring. We put them all together, and now we have two deposits that probably be the next two gold mines in Canada. They're almost fully permitted. And again, I could say this about Copper Giant, which we acquired a fantastic prospect. It's a prospect, it's not, it's exploration, but again, got into trouble. We bought it for very cheap, put it in different management. Argenta Silver was our silver project in Argentina. Again, it was part of a bigger company that had run into financial trouble. We bought the asset for $3.5 million. They'd spent about $80 million developing it, drilling it, put all the infrastructure. We put in different management, fresh capital, and there we go again. And so that strategy seems to work. And we just announced last week, Minto, the Minto copper mine in Yukon was in bankruptcy, and we worked with the First Nations group, made them our partners, and took control of that, and now it's called Selkirk Copper. So that's another formula that seems to work for us.
Notice, by the way, that Frank had the good sense to make most of those companies exhibitors at this conference.
Yeah.
Adrian, talk your book.
Yeah, well, unlike Frank and to some extent Jonathan, we don't go in and try to fix management or anything like that, although I frequently vote against management, you should be aware. But so we're going into companies with existing management, and I mention that as a prelude because for me, management is the most important thing I look at. It's not deposits, sorry, because I'm not a geologist, but management is the most important thing I look at. And as you said, Jonathan, and I'll even go further. You can have a good person with no money and a lousy deposit, or a bad person with a lot of money and a good deposit, and I will take the first one every single time, because that person will work hard and not focus, not waste money, and get a different deposit, and so on and so on. So anyway, management is the most important thing to me. I'll give 3 companies, and I think they all have relatively short-term, well, no, that's not true. Sorry, let me take that back. 2 of them have relatively short-term catalysts. One is not an exhibitor, and that would be Altius Minerals, Brian Dalton, and the absolute top resource management team in the business. And what they've done over the years, unlike most people in this business, most managers in this business, they've actually not just talked about cyclicality, but they've acted counter-cyclically, which in this business is absolutely essential. So they will go periods of time when they don't buy anything because prices are just not right, it's just not the time, and then when the market's down and out, that's when they spend the money. Anyway, that's one. There's 2 that are exhibitors that I'll mention, and they're both small, and a lot of people are going to shoot me because I didn't mention them, but I can't mention everyone. One would be Origin Royalties. As probably most of you know, they have just sold to Triple Flag. It closes today, in fact, in an hour, I think. It closes today. They have just sold their largest asset, which is a royalty on the silicon deposit that Anglo Gold has at the southern end of a BD trend, 13.2 million ounces. They've just sold that to Triple Flag, closes today, and then the rump, everything else will spin off into the new Origin, which will also be called Origin Royalties with the same symbol, OGN. I think, I'm not saying they're going to do it again, go from 35 cents to $2, but I think they're going to do something pretty similar again. It may take 2, 3, 4 years, but again, the key is you have some really great people, they have a good balance sheet, and they do have cash flow coming in. It's a junior exploration company with free cash flow. That's an unusual thing. And the reason I hesitate to mention it is because I'll be buying it on Monday when it starts trading. Won't you, Rick?
As I will, yeah.
So I really don't want you guys competing. Can you all wait till Tuesday? And then the other the other one I'll mention very quickly will be Lara. They're also out there, Lara Exploration. Again, they've got a copper project, not a huge one, but a decent copper project called Planalto in Brazil. But again, the people, and they're all here. Simon Ingram, the CEO, Miles Thompson, the chairman, and then Chris McIntyre, the development officer. They're all here, so you can talk to them. And when you talk to them, you'll see these are people who really know what they're doing, and that's why I buy the company.
Ralph?
Yeah, I'll talk my book on one of the companies that's here is Vizsla Silver. If you're looking for a silver exploration company, that's probably what I would be recommending to buy. There's also Vizsla Royalties, which is another way to have a little extra play on that. As far as another silver producer, Aya Gold and Silver is probably one of my biggest silver holdings. Benoit LaSalle, the CEO, he's got a great track record, is what I would say. And they are hitting some hiccups right now in terms of getting their second mine brought up to where they want it to be steady state. But that one is one of your purest silver plays out there. On the gold producer side, K92 is my biggest holding there. They just reported quarterly production today. They came in slightly above expectations. Not a barnstorm one like the prior 2 quarters, but they're showing consistency. And if they do that, that will get them there. And TriStar Gold is a fully permitted project in Brazil for gold. The guys who found it are the same guys who found Tokazinsu that G-Men bought. So that would be my recommendations.
So, ladies and gentlemen, we've heard from the investing legends. We've heard how they've done what they've done. We've heard what they've done wrong, and we've heard what they're doing now. There's a whole bunch of reasons why I wanted you all to hear this, but what I'd like is for you all to become investing legends yourself. I hope we've given you a roadmap, and I hope in addition to giving you a roadmap, we've done something that'll sustain you until you have the education to emulate the living legends. Ladies and gentlemen, join me in a big round of applause for my panel.